Hello number-curious friends, welcome back to the channel where we talk accounting and finance. Today we'll wrap up the fixed assets topic and unpack fixed assets on the balance sheet of a real global company, Unilever. We'll see what counts as fixed assets under IFRS, which buckets are the biggest and how this maps to our Apple Shop example. Under IFRS, fixed assets mainly show up in three places, two of which are already familiar to us. The first one, tangible fixed assets, officially property, plant and equipment, PPE, for example, factories, machinery, warehouses, trucks. The second one, intangible fixed assets, for example, goodwill from acquisitions, plus brands, trademarks, software and similar. And there is also a third one, which we will cover in a separate lesson later, right-of-use assets. These are assets that you use via leases, under IFRS 16. Like leased offices or warehouses. You don't own them, but you record a right to use them. Let's have a look at Unilever's balance sheet. It shows the split of non-current assets on page 140 of the annual report. What do we see here? As at 31st of December 2024, Unilever recorded goodwill of approximately 22.3 billion euros, intangible assets, brands, software, etc. of approximately 18.6 billion euros, and property, plant and equipment, 11.7 billion. Notice how intangibles and goodwill, which are about 40.9 billion in total, are much larger than the PPE. That's common for global consumer brands where brand value and acquired portfolios carry big weight. And separately on right-of-use assets. Unilever recognizes right-of-use assets under IFRS 16, and they sit in non-current assets alongside property, plant and equipment and intangibles, even though they are leased, not owned. Let's briefly discuss goodwill, an asset which we have not discussed yet. We see it as approximately 22.3 billion. Where can we find details? In note 9, as reference on the balance sheet. Let's check it out. But before we look into the note, what is goodwill actually? Goodwill arises when Unilever buys a business for more than the actual value of its net assets. For example, a premium paid for scale, brands, know-how. Here you see an example. Unilever bought businesses with net assets of 333 million. Of this, 27 million belong to others who co-own the acquired businesses. And for this, Unilever paid 616 million. The difference between the payment for businesses and what they actually acquired is goodwill. In this case, in 2024, Unilever recorded 310 million of goodwill on acquisitions in its balance sheet. Goodwill isn't amortized in accordance with IFRS, instead it is tested annually for impairment. Is the acquired business still worth what we thought? Note that under certain local accounting policies, for example German GAAP, goodwill can be amortized. Now let's move to note 9. What do we see here? Goodwill is shown as a separate position in the table. It started at 22.3 billion in January 24, and then Unilever added new goodwill through acquisitions, 310 million, exactly the number we have discussed. When you sell a business, you take out goodwill you had for these businesses. So we see minus 60 million here, and note how there is no amortization recorded for goodwill. Now we move to other intangible assets which are about 18.6 billion. This bucket includes brands and trademarks, formulas, technology and software. Here you see that intangible assets are split into indefinite life assets and finite life assets. Indefinite life assets, for example brands, aren't amortized but are impaired tested. Again, is value still there? Here we see an impairment of 127 million. We will come back to that in a bit. Financial statements disclose that within indefinite life assets there are 5 brands that have a significant carrying value. One of them is valued at 2.7 billion. Some assets like software and customer lists are finite life and amortized over time, over their expected useful lives. Annual report states that none of the amortization periods exceeds 10 years. And now we move to property, plant and equipment, which has 11.7 billion euros in it and consists of owned and leased assets. Let's check out note 10a and owned assets. The note on page 163 states that they are depreciated based on major classes and useful lives deviate between 2 to 20 years for plant and equipment or 40 years for buildings. Quite a deviation, right? But in general, PPE is depreciated over its useful life to match cost with benefits it provides. Property, plant and equipment covers the physical backbone of the business, manufacturing sites, equipment, logistics. In our Apple business, that's our truck, wearing down a little every year. The note splits property, plant and equipment into land and buildings, which were 3.4 billion as of December 24, and plant and equipment, which was 6.9 billion. Another part of PPE is leased assets. They were 1.4 billion as of December 2024. And the international accounting standard which regulates leases is IFRS 16, and which requires recording right-of-use assets for the leases. It is a very interesting standard which has important implications on the valuation of businesses. We will discuss it in a separate lesson. Let's quickly check the note 10b. Here we see that Unilever has land and buildings right-of-use assets valued at 1.1 billion as of December 24 and 0.3 billion of leased plant and equipment. Both add up to 1.4 billion we see on the balance sheet. Now let's zoom in on property, plant and equipment. On the 2024 balance sheet, PPE stands at about 11.7 billion, up from 10.7 billion in 2023. So, a net increase of roughly 1 billion year over year. What drove that? Where can we see the investments the businesses make? Correct, in the cash flow. Let's quickly move to the cash flow statement. To keep assets productive, Unilever invests in Capex, new and replacement assets. In 2024, net capital expenditure was about 1.9 billion. This includes cash flows for purchasing property, plant and equipment and intangibles, principally software, net of disposals. The cash flow note shows 1.7 billion of purchases of PPE during 2024, partly offset by small disposals of 37 million and the usual depreciation running through the P&L. So, the story is ongoing reinvestment in plants and equipment with only limited asset sales. On the expense side, the group reported 1.8 billion of depreciation, amortisation and impairment flowing through operating profit. Remember, that's a non-cash line in the period. The cash went out earlier when the assets were bought. And you see, in the cash flow it is added back. And note, this figure is combined and covers both PPE depreciation and intangible amortisation. What about impairments? Did anything get written down? In 2024, Unilever booked 127 million of impairments, principally relating to Blue Air, their air purification business. These impairments can include PPE or intangibles, depending on where the value loss sits. In the annual report, there is no split of the 127 million by asset class. And remember the 127 million of impairment of indefinite life intangible assets that we mentioned a few moments ago? Here you go, that's exactly what it was. You'll also notice lease accounting effects. Unilever pays for many sites via leases. Total lease payments in 2024 were 500 million. At the same time, in cash flows, the capital element of lease payments was 0.4 billion. The rest is running via interest expense, 77 million. That's IFRS 16 at work. As I said, an interesting standard which deserves a separate lesson. It's also a reminder that not every factory or warehouse is owned. Some are leased but still sit on the balance sheet in a different bucket. 2024 also included several disposals of businesses, recorded as a net loss on disposals in non-underlying items. When whole businesses move, some related property, plant and equipment leaves with them. That's one reason you'll see assets held for sale and disposal lines moving year to year. So, when you read Unilever's balance sheet, what are the key items to look out for? Here is a beginner-friendly checklist. Unilever has an intangible-heavy model. Consumer giants often have more intangibles than factories. For Unilever in 2024, Goodwill plus other intangibles outweigh PPE, so performance and brand health really matter. Then additions versus depreciation and amortization. Look at Capex trends. Is investment keeping plants modern? Does brand tech investment continue via software intangible additions? Quick check for that. Is capital expenditure larger than depreciation and amortization? If yes, that's a good sign. And for Unilever in 2024, net capex was 1.9 billion, which is higher than depreciation and amortization of 1.8 billion. Impairment. Any write-downs of goodwill or brands tell you a business line underperformed relative to earlier expectations. Unilever discloses impairments and other non-underlying items separately. Leases or right-of-use assets. These put leased assets on balance sheet. Not all assets are owned by the business, but it's not a bad thing. And now, link to returns. There is one key performance indicator called return on invested capital, which is calculated as operating profit after tax divided by invested capital. Invested capital is typically non-current assets and working capital. Unilever calculates it using an average of Goodwill, Intangibles, PPE and working capital. It helps you see how effectively those assets generate operating profit. In 2024, Unilever achieved 18.1%, which was higher than the previous year and also highlighted in their annual report. Let's now map Unilever's fixed assets to our Apple business. In our Apple business, property, plant and equipment is our great truck. Of course, we can add an apple orchard here, or a juice press. In Unilever world, PPE results from huge global factory and logistics footprint. We can also create an Apple shop brand, Best Apples Company, and we will have our own intangible. Unilever intangibles are major brands and software. If we rented a store, we would have an Apple shop lease. Unilever reports right-of-use assets, leased offices, warehouses, manufacturing support sites under IFRS 16. Both our Apple business and Unilever invest cash, Capex, and then depreciate or amortize over time. Your cash flow statement will show the outflows, while the income statement spreads the cost. Now, how can we conclude on what we have looked at today? Unilever's fixed assets are led by Goodwill, 22.3 billion, a lot, and other intangibles of 18.6 billion. But property, plant and equipment of 11.7 billion is also significant. Net Capex in 2024 was 1.9 billion, which is higher than depreciation and amortization. A good sign. Watch impairments, Capex versus depreciation, lease balances and return on invested capital to understand how well assets are working. So that would be it for today. Thank you for watching. If you enjoyed this video, hit like, subscribe and ring the bell so you don't miss the next lesson. See you soon and keep those debits equal to your credits.